If you're a veteran buying a home in North Carolina and you have debt you want to get rid of, I want you to watch this entire video before you make an offer on anything. And I have the actual closing disclosure from a real deal in Raleigh to prove it. I recently helped a veteran in Raleigh pay off 2 credit cards at closing. His mortgage payment was higher than his rent had been, but after paying off those credit cards, his total monthly debt obligation was actually lower than before he bought the house. I've also used this strategy to pay off car loans, a private school bill, and even a lease break fee so a veteran could get out of their rental and into their new home. By the end of this video, you're going to see exactly how that Raleigh deal was structured, how the numbers worked, and how to set up your deal the same way before you ever sign anything. Start with the rule everybody gets wrong. VA pamphlet 26-7, chapter 8, page 11, the 4% limit. It says seller concessions exceeding 4% of the established reasonable value of the property are considered excessive for VA guaranteed loans. Most people read that and stop. But the very next sentence changes everything. Do not include normal discount points in payment of the buyer's closing costs in total concessions for determining whether concessions exceed the 4% limit. That means all of your actual loan costs, origination, appraisal, title work, recording fees, do not count towards the 4%. The 4% applies to a very specific and short list of items. And when you understand what's on that list and what isn't, you realize there's significantly more room to work with than most people think. Here's the worksheet I run on every deal. 2 buckets, fees not included in the 4% and fees included in the 4%. Let me show you what this looks like on the actual closing disclosure from this deal. Fees not included in the 4%. Section A, origination charges. Application fee, $13.90. Loan origination fee, $14.80. Processing fee, $727, all not counted. Section B, services the borrower did not shop for. Appraisal, not counted. The VA funding fee was financed into the loan, also not counted towards the 4%. Section C, services the borrower did shop for. Title fee, settlement fee, title insurance, not counted. Section E, recording fees, excise tax, not counted. Daily interest, not counted. Real estate agents' commissions and fees also are not counted towards that 4%. Since August 2024, under the new VA Circular 26-24-14, veterans can now pay their buyer's agent fee directly at closing. It doesn't count toward the 4% cap and requires a written buyer-broker agreement in the file. Either way, it does not eat into your debt payoff room. Fees included in the 4%. Section F, prepaids, homeowner's insurance premium, $811, counted. Section G, initial escrow, homeowner's insurance, escrow, $202. Property tax escrow, $337, counted. Section H, this is where debt payoffs live. You can see right here on this closing disclosure, debt payment to GS Bank, $1,769.50. Debt payment to Capital One, $2,342. A combined $4,011, both counted towards the 4%. When you hear someone say that the max seller credit on a VA loan is 4%, just know this is not the full picture. Only a portion of your closing costs fall in that 4% bucket. You actually have the ability to use a lot more of the seller's money than you would think. Here's exactly how this deal came together. Original purchase price, $284,900. Seller paid closing costs, $10,305. Offer accepted. The appraisal came back at $289,900, $5,000 above the purchase price. Because we had the appraisal gap conversation up front, we amended the contract. Purchase price up $5,000, seller's credit up $5,000. New purchase price, $289,900. New seller paid closing costs, $15,305. The seller netted the same amount. The veteran got $5,000 more in seller credits applied towards debt. We probably could have pushed further, but this veteran wanted to keep some equity in the house. It's a completely valid choice. The point is, the option was there because we set it up correctly before the offer was signed. Here's how the worksheet broke down on the final numbers. Total loan amount, $289,900. Total seller credit, $15,305. Non-4% fees, Origination 3598, appraisal and credit report 931, title and settlement $1,751, recording fees and excise tax $670, daily interest $817, other Section H fees $2,040, total roughly $9,808. Of the $15,305, $9,808 covered all standard loan costs inside the 4% bucket, hazard insurance, property taxes, the initial escrow payment. That left over $4,000 for debt payoffs, both paid off at closing. The 4% limit, $11,596. Total 4% fees was only $5,733. No reduction needed. File closed. The veteran's mortgage was higher than his rent had been, but after paying off those 2 credit card bills at closing, his total monthly debt obligation was lower than before he bought the house. His mortgage went up, but his total debt went down. That is precisely the type of scenario where this strategy makes sense. Here's the exact sequence that made this deal possible. Before the offer was made, 2 conversations. The first is internal, between you, your buyer's agent, and your loan officer. Your plan is to buy the house for what it appraises for or less. You don't announce that to the listing agent. That's your internal strategy. The second conversation is what your buyer's agent has with the listing agent. If the house appraises above the purchase price, we want the ability to increase the seller credit by that difference. On this deal, the house appraised $5,000 above purchase price. We amended the contract, increased both the purchase price and the seller credit by $5,000. The seller netted the same amount. The veteran got more money applied toward debt. A good listing agent who wants to get this deal done can sell this to their sellers, especially if they say, hey, we're not going to increase the agent's commission. The higher appraised value raises comps in the area. The seller nets the same. Everybody wins. The only time I've had this not work is when the listing agent didn't understand the deal well enough to explain it, and the conversation didn't happen up front. That's why this conversation happens before the offer, not after the appraisal comes in. Here's something that most veterans and most loan officers don't fully understand. Anything that shows up on your credit report can typically be paid off at closing using seller credits, as long as we can get a payoff statement. Car loans, credit cards, personal loans, medical debt, student loans. If it's on your credit report and we can get a payoff statement, there's a strong chance we can get it paid off at closing. But I've also paid off things that weren't even on the credit report. I've paid off a private school bill that was delinquent. I've paid off a veteran's Subaru. I've even paid the fee a veteran owed to break their lease so they could get out of their rental and into their new home. Talk to your loan officer before you assume everything qualifies. The general rule is, if it's on your credit report, it's straightforward. If it's not, it may still be possible, but confirm it with your loan officer first. North Carolina is a big market with a lot of inventory across the state. Not every property is the right fit for this strategy. If you ask for 4% in seller credits on a listing that's going to have multiple offers this week, your offer is going to get passed over for somebody offering asking price with no seller concessions. But filter Zillow by days on market and look for properties sitting 30, 45, 60 days or more, especially ones with price cuts. And those sellers are in a different position. They may be carrying 2 mortgages. They may have already relocated for work. Whatever the reason, their urgency is your leverage. Work with your real estate agent to find properties where the seller's urgency works in your favor. This strategy is powerful, but it doesn't always make sense. Think of every mortgage like braces. The goal is always to get them off as fast as possible. If you're in a strong financial position, no high interest debt, no liabilities dragging you down, the best move is to get your closing costs covered, walk into your home with equity, and pay your mortgage down as aggressively as you can. But if you've got debt at high interest rates eating into your cash flow every single month, and you're going to buy a house anyways, this strategy can change your financial picture at the closing table. Pay off the debt, drop your monthly obligations, give yourself room to breathe, save, give, invest, and enjoy the home you just bought. That veteran's mortgage was higher than his rent, but his total monthly debt was lower the day after he closed than the day before. That's when this is worth doing. The 4% rule on VA loans is widely misunderstood. Your actual loan costs are not counted towards the 4%. The 4% applies only to insurance, taxes, escrow, and debt payoffs. Real estate agent commissions don't count toward the 4% either. Since August of 2024, veterans can pay their buyer's agency fee directly at closing under the new VA circular. On this North Carolina deal, we started at $284,900 with $10,000 in seller credits. The house appraised at $289,900. We amended both purchase price, and seller credits went up $5,000. Final seller credit over $15,000. 2 credit cards paid off at closing. Total 4% fees, $5,733. No reduction needed. The veteran's total monthly debt was lower after closing than before. To use the appraisal gap strategy, internally agree to buy at or below appraisal with your buyer's agent. Have your buyer's agent discuss with the listing agent the ability to increase seller credits if the house appraises above purchase price. Do this before the offer, not after. Anything on your credit report with a payoff statement can typically be paid off at closing. I've paid off car loans, credit cards, a private school bill, a veteran Subaru, and even a lease break fee. Talk to your loan officer. The list is longer than most people think. Look for motivated sellers in North Carolina. Days on market and price cuts are your best indicators. And if you're in a strong financial position with no high interest debt, skip this debt payoff strategy completely. Get your closing costs covered, walk in with equity, and pay off your mortgage as fast as you can.